Hello and welcome to the Fishbowl. I'm your host, Brad Lineberger, Certified Financial Planner, along with our other host, Matt Callahan, also CFP. And today we're going to be having a casual conversation on dividends. What do we say, a deep dive on dividends?
Yep, triple D, deep dive on dividends.
Triple D. What are your thoughts on dividend investing, Matt?
I like dividend investing as part of an overall portfolio. I don't think it should be your end-all be-all. This is what we see people running into, and it is a bigger issue than they think.
Meaning their focus is totally on dividends?
Well, yeah, if you're focusing only on dividends, there's certain companies and stocks out there that pay dividends and others that don't. And so what I mean by that is if you're only focusing on these dividend-paying vehicles, then you're missing out on other opportunities in growth space, mid companies, small companies. Think of Apple way back in the day wasn't paying any dividends because they needed to take all the income, if any income that was coming in, put it back into the business to grow that business over time.
That's so true. It's funny. It seems like the companies that are paying dividends tend to be of a certain, they tend to be large and they tend to be considered value companies where the price to book ratio is lower relative to their growth counterparts. And I noticed that people's portfolio gets a little concentrated in these big dividend paying. You're totally right. Mm-hmm. They're missing out on other parts of the market, which I think hurts the portfolio.
Yeah, or even if they thought they were plenty diversified and had these other companies, if they're not adjusting the portfolio or rebalancing, maybe these mid-sized companies are becoming these value companies paying these dividends. So when they think they're being diversified with all these companies, they could be reducing the exposure to other areas of the market.
Right, and what's crazy, think about the run that we've had in growth companies for the last 10 years. If you missed out on growth companies because you were overly concentrated in value, I mean, shoot, what is it, Matt? I think growth compounded at like 12% per year over the last decade. Value was 9%, not bad, but that's 3% per year of returns that you'd be missing out on.
And correct me if I'm wrong, you're trying to see, or thinking that it's got to flip at some point, right? So you may be putting a bigger bet on value versus growth?
You could be, but the last 10 years you've missed out on a lot of returns. Mm-hmm. It's just weird. I see the portfolios get overly concentrated in particular sectors and areas of the market. Mm-hmm. And I think people do it in the name of safety, or maybe I don't know what it is. It's the income I think that they like.
Yeah, they tend to think that these companies can't lose value because obviously if it's paying extra income, and I say extra income because it's not extra income necessarily that's coming in. If you look at the share price of these stocks, whenever they pay a dividend, if it's a $20 per share, they pay $1 share or of a dividend, that share price is now $19.
Right, nobody knows that.
They overlook that and just think, oh, it's paying a dividend, this is safe. More often than not, a lot of the time that these companies are paying dividends to attract new investors because they don't have the revenue that they need.
Right, and you told me that story. Dividends aren't guaranteed. Mm-hmm. I mean, companies, it was Walgreens, WAB.
Yeah.
Walgreens.
Alliance,
That's right. They stopped paying dividends altogether just recently, earlier this year. Mm-hmm. I mean, literally they stopped paying dividends.
Right, so dividends aren't guaranteed, and if the company's not growing, then that stock price stays the same. So if you still need income out of that portfolio, now you're tapping into your principal, and if it's not growing anymore, then you have a risk of running out of money in retirement.
Right. Well, another great example of this is Franklin Resources, where they had a really healthy dividend. It was like 6.4 or something, but the share price was down 20% year over year. And it's like people are anchoring in, there's income, but the share price has gone down. The capital appreciation, I think, is overlooked.
Mm-hmm. So when we're looking at it, dividends are great, but you do want to have growth companies in there as well to kind of balance out the portfolio, have an extra layer of diversification in there.
So we like to take what we call the total return approach. I mean, how would you describe that total return?
As in simple terms, total return, putting some in dividend-paying stocks or value companies, some in capital appreciation stocks, but at least you're having some part of the portfolio continuing to grow and beat inflation to keep that purchasing power strong.
Yeah, I know. I think that I just see people are adding risk to the portfolio when they tilt it too much.
And you know what's ironic about this is that people that do dividend investing think that they are they feel more conservative, and then when you look under the hood of their actual portfolio, they're taking way more risk than what they should be.
Because they're concentrated. They're making big bets in really specific sectors. I know. There's an irony there. Okay, so any other thoughts on dividend investing or kind of how it fits, how it should fit in someone's retirement income plan?
Yeah, I definitely think it should fit in the portfolio. I don't think it should be your end-all, be-all if you're trying to accomplish a well-diversified portfolio.
Yeah, right. So don't forget your large growth. Don't forget your small caps. Don't forget your mid caps. In fact, like we said, they've had a fantastic run, but a diversified portfolio ought to have that. Yeah. When I look at some of our portfolios, because the question I'm sure the audience is wondering, well, what's a good healthy dividend yield? What should we be achieving? And, I think somewhere 2.5–3% is a nice healthy yield. Certainly not the highest yield you could have, but that seems to be a sweet spot where you can still have some growth orientation in the portfolio.
Yeah, I agree with that as well, because if you're starting to get north of that, that's when you're chasing yield, and it's probably not as safe as a company that you would hope for.
I think I've heard you say it's less, a company's not going to go out and just double its dividend. To get that higher yield, more than likely, their share price has been cut in half. That's what's jacked up the yield.
Right.
People don't realize that. That's what's adding the risk to the portfolio.
Right. And then, going off of another topic, if you're doing a 4% distribution rule or 5% distribution rule, if that value stock isn't growing that much and then the dividend goes away, like you mentioned earlier, then we're depleting there. And so having the growth stocks in there can provide more income over time, potentially.
Yes. Yeah, that's a good point. Let's talk about taxes on dividends. Just kind of walk us through what the tax situation looks like.
Really good question, because we've got two different taxes that can be happening here. There's ordinary income tax, or there's qualified dividends. So ordinary dividends and qualified dividends.
What is that?
Yeah.
What is the
so
difference?
Ordinary dividends are dividends paid out by a majority of the companies, and so you're just paying your ordinary income rate on that.
So whatever tax, whatever rate, wherever I'm at in the bracket, that's what I pay.
Which is typically higher than what your capital gains rates are, right? And so qualified dividends you'll be paying capital gains rates, long-term capital gains rates, which are 0, 15, or 20%, depending on that marginal tax bracket.
Right. Seems like most Americans, or at least a lot of, somewhere in that 15% capital gain. I think married filing jointly, your income's got to be north of 553 to be in 20.
Right.
And if that's your, it's a good problem to have. If
They're
that's
probably, waving their hands way in the air to pay 20% at that point.
Well, that's true, because if you're at 553, you're in the 35% ordinary income bracket. You would gladly pay 20 on capital gains.
But so another thing, now we're running into another issue. Well, why Matt, why Brad, why do you invest in qualified dividends when you could get ordinary dividends when you could be getting these qualified dividends?
So should we put the whole portfolio as qualified dividends?
That's when we're running into a big landmine potentially, because the ordinary dividends are usually provided from large U.S. companies. So
Qualified.
Qualified.
Yeah, right.
Yeah, so now you're going again and doing the only large U.S. companies to get that, and we're forgetting about the international investing.
Right. So in other words, sometimes we see people walk in here with portfolios that are 100% qualified dividends, and that's great from a tax perspective, but they're typically missing out on small growth, large growth, on international, small, emerging markets, real estate. So that portfolio, again, is under-diversified. And then we have an old, don't let the tax tail wag the dog.
Right.
So yes, your dividends are taxed more favorably, but you don't have a diversified portfolio. In fact, I'm curious your thoughts. My estimation is ideally you want to have maybe 70% of your dividends be qualified and the other 30%. That seems to be a good benchmark.
Yeah, I like that. 70-30, that way you have another layer of diversification there within your diversified portfolio.
Yeah. Yeah, and I think you can have 70% of the dividends be qualified and still I think you're diversified enough.
And don't get me wrong, we love U.S. investing, we love dividend-paying stocks, we love all of the above,
Yeah.
but you need to properly align them with what your goals and objectives are,
Right.
and make sure you don't blow up a 20, 30, 40-year plan.
Right. I mean, I just think that there's more than me. It's not as simple as, oh, own a few dividend-paying companies and forget about it, or even own a couple of these ETFs that focus on dividend payers. It's way more complex than that. And to your point, I think if you're not careful, you can step on landmines.
So it sounds simple on paper, like you're saying, but gets more complicated when you start peeling back that onion.
It always does. It always does, no matter what topic it is. All right. Well, thanks for joining us today. Any other thoughts on dividends?
No, very simple but complex.
Hope you enjoyed our talk on dividends today. I'm Brad Lineberger, Certified Financial Planner, with Matt Callahan, Certified Financial Planner. We're with Seaside Wealth Management in Carlsbad, California, and we help people every day transition into retirement and stay comfortably retired. If you want to talk about strategies to help yourself transition into retirement, get in touch with us. There's a link below in the description, and we'll be sending you more content like this, so make sure to like and subscribe the channel, and we'll see you soon.